Welcome to the Deep Dive from TalkTickers. We zero in on the crucial details from earnings calls so you can get straight to what matters. Today, we're diving deep into the fiscal third quarter 2025 earnings call for ReposiTrak.
Right.
The tone from management was, well, definitely confident. It looks like a pretty strong performance overall.
Yeah, it did sound that way. Lots of focus on execution.
But what do they really say that gives us the shortcut, to understanding where this company stands? Let's dig in.
Okay. Yeah, that call certainly presented some compelling points. Like you said, they focused heavily on execution, and the numbers they shared definitely underscore that for the quarter.
So let's kick things off with the essential numbers. Q3 2025, total revenue saw a healthy increase. It was up 16%.
Yeah, 16% to $5.9 million compared to $5.1 million last year.
Right.
And the critical part here, I think, is that 98% of that revenue.
98%.
Yeah, $5.8 million was recurring. And that recurring piece showed a solid 15% increase itself.
That's strong. And expenses. How did they manage those?
Well, they were pretty well managed in comparison. Operating expenses only increased by about 7%.
Just 7%. Okay, so that discipline obviously flowed down.
Exactly, right to the bottom line. Income from operations jumped significantly, up 43% actually.
Wow, 43%.
To $1.8 million versus $1.3 million in the prior year.
Okay, and GAAP net income.
Also saw impressive growth. It climbed 27% to $2 million. That's up from $1.6 million.
Right.
And net income specifically for the common shareholders grew even faster, rising 33% to $1.9 million compared to $1.4 million.
So per share, what does that translate to?
On a per share basis, both basic and diluted earnings came in at 10 cents.
Up from 8 cents last year?
Yep, up from 8 cents. And looking at the balance sheet, cash position looked good too. They finished the quarter with $28.1 million in cash.
Solid. Did they give year-to-date context?
They did, yeah. They gave us a look at the first 9 months of the fiscal year, and it shows pretty consistent trends. Total revenue for the year-to-date was up 10.3%, hitting $16.8 million. And recurring revenue, again, the key part, increased 9% year-to-date to $16.6 million.
And expenses year-to-date?
Also kept in check. Total operating expenses up just 6% over the 9 months.
So income from operations?
That was up 25% year-to-date, reaching $4.6 million.
Nice. And to the common shareholders?
Net income to common shareholders for the year-to-date period was up 24% to $4.9 million.
Okay.
And this translated to year-to-date EPS of 27 cents basic, 26 cents diluted. That's an increase of over 22%.
Okay, so the numbers are definitely solid. You see that revenue growth converting nicely into accelerated profitability.
Right.
But that leads us, I think, to one of the biggest takeaways from the call. How exactly are they doing that, achieving this accelerated profitability?
Yeah, they spent some time on that.
Management really emphasized their strategic goal, didn't they? Grow annual revenue double-digit, like 10, 20%. That rate, but grow profitability even faster. And they sound pretty confident they can keep up that 10, 20% top-line growth for the foreseeable future.
They did. And what's absolutely critical, I think, to understanding their model is this idea of contribution margin.
Right. Explain that bit.
Okay, so they converted $828,000 of incremental revenue in Q3 into $415,000 of incremental GAAP net income. So do the math. That's about 50 cents on every new dollar of revenue dropping to the bottom line right now.
50 cents already sounds pretty good.
It is. But here's the kicker and maybe a major insight from the call. They explicitly stated their goal is to reach an 80% contribution margin.
80%. Above what?
Above their core fixed costs.
Yeah.
Exactly. They clarified their target is to get 70 to 80 cents of profit on every incremental dollar above the, roughly $12 million annual cash cost it takes to just run the business.
Okay, so $12 million is like the baseline cost.
Yeah, think of it like keeping the lights on, the engine running, excluding non-cash stuff.
Gotcha.
Once they cover that baseline, they aim to make 70, 80 cents profit on every new dollar of revenue they bring in after that.
So they're working to push from the current 50 cents towards that 70, 80 cent target.
Precisely. That's the goal they laid out.
That's a significant leap. It suggests some really powerful operating leverage baked into their model.
Definitely.
They also spend quite a bit of time detailing their capital allocation strategy. That felt like another key piece of the story.
It did. Their stated goal there is to return 50% of their annual cash from operations to shareholders.
Right, 50%.
While banking the other half, just putting it in the bank.
And they have a track record with this.
They do, yeah. They pointed out that since inception, they've returned over $25 million in total capital.
Yeah.
That's through, dividends, buybacks, redeeming that preferred stock they had, and paying off all their bank debt.
And just this year.
In the first 9 months.
Yep. Just in the first 9 months of this fiscal year, they've already returned $3.7 million.
And they highlighted the preferred stock redemption specifically. They've paid off $4.6 million of it so far.
How much is left?
About $4.2 million left. And at the rate they're going, they expect to fully pay it off by September 2027, maybe even earlier.
Interesting. What about common stock?
Also, consistent buybacks there. They've repurchased 2.2 million shares to date. And the cash dividend. They've increased that by 20% since they first started paying one.
And crucially, no bank debt.
No bank debt, which gives them, significant financial flexibility.
And the board's involved in this?
Very much so. They said the board evaluates this capital allocation strategy quarterly, maybe even more often, just to make sure they're deploying cash in the way they think is best for shareholders. Makes sense.
Management tried to boil down their core strategy pretty simply, didn't they?
Yeah, it was like a 3-point plan almost. First, take exceptional care of the customer, always number one. Second, execute flawlessly, which means, grow that recurring revenue, balance costs versus opportunities, keep boosting profitability, EPS, cash generation. And third, use that cash strategically. Buybacks, preferred redemption, dividends, and keep that debt-free balance sheet.
They describe it almost like a loop, right?
Yeah, a virtuous cycle. Customer success means they buy more.
Which drives revenue growth.
Which, because of their model, accelerates profitability even faster.
Generating more cash.
Which lets them return more capital to shareholders.
Ultimately boosting EPS. Simple on paper, maybe?
Well, they were clear. It requires a top-notch team and a lot of hard work. But the model itself is designed for that kind of acceleration.
Okay, so that's the how. Now let's talk about what's really driving this performance, maybe from an investor's angle.
Right. Management highlighted growth across all their main business lines: traceability, compliance, and supply chain.
And a central theme here, probably the engine behind that operating leverage we talked about.
Has to be the single technology platform.
Exactly. They really hammered that point. Building all their solutions on one platform creates, what do they say, enormous financial and operational efficiencies for them.
Yeah, and they see it as pretty unique, having such a broad suite all integrated like that.
And it's not just about their own efficiency, is it? It's a big plus for customers, too.
For sure. It gives them a consistent experience, builds comfort, trust, simplifies customer service.
And the tech works.
And features technology that, as management put it, actually works. Always good.
And this platform seems to be directly fueling their cross-selling efforts, too.
Absolutely. They said those initiatives are gaining momentum because customers who've already put in one solution, provided their data, find it incredibly easy to just add other offerings like traceability or supply chain tools right on the same platform.
Because it leverages the data and effort they've already invested.
Exactly. It just lowers that hurdle for customers to add more services. Makes it easier to say yes.
And speaking of efficiency, automation came up too.
It did. They specifically called out their automated wizard. Apparently, it lets about 2/3 of new traceability customers on board with minimal or even no human help.
2/3? Wow.
Yeah, they said it exceeded their expectations. And it's a big factor in how they can operate so efficiently with a, relatively small team. Only 67 employees.
That is lean. Okay, they also had to address the FDA FSMA 204 deadline extension, right? The food traceability rule.
Yes. And interestingly, management didn't seem worried. They actually saw the 30-month extension as, quote, exactly what we were hoping for.
Really? Why?
Well, the reasoning was it allows for smoother onboarding across the industry, ensuring systems are fully working, data is accurate, less of a mad rush.
Okay, that makes sense. But here's a crucial insight, I think. You might expect an extended regulatory deadline to slow down adoption, wouldn't you?
You might. But management explained that while the enforcement deadline shifted, the law itself hasn't changed. And critically, they said, and this is another key quote, market forces have taken over.
Market forces. What do they mean by that?
They mean the leading retailers, they name names like Kroger, Albertsons, Walmart, Target. They are driving adoption now. Not just to comply with some future regulation, but to protect their own brand and improve their operations today. Food safety is paramount for them.
So the retailer's commitment is basically pulling the rest of the industry along.
That's the idea. compelling everyone else to get traceability capable now, regardless of the final FDA date.
That dynamic is creating a powerful network effect, they suggested.
Exactly. They described a shift. It used to be retailers pushing their suppliers onto the network. Now, those suppliers are pulling their own downstream suppliers onto the network, too. It's building on itself.
And ReposiTrak sees itself as
the go-to solution. They argued they're building arguably the largest operating traceability network in the world.
the claim.
It is. And that scale and position, they say, is attracting attention, leading to new partnerships, more commercial inquiries.
Okay, looking ahead, new products.
Yeah, they mentioned new products are in the hopper, all being built on that same core platform, naturally.
Based on customer needs, presumably.
Right, based on customer needs. They gave examples of logical extensions from where they already are. Think recall management building off traceability.
Okay, makes sense.
Or developing deeper ordering and forecasting tools based on their shipment tracking capabilities.
And the margin on these.
Because they're built on the same platform, leveraging existing account management, they expect these add-ons to come with an even higher margin.
Higher than the core. Okay,
Yeah, development costs are essentially fixed at this point, is the idea.
got it. The analyst Q&A must have dug into some of this. What came up there? Tariffs?
Tariffs came up. Management felt the impact was pretty small for them directly.
Okay.
It mainly just introduces some general uncertainty in the food industry, which, can sometimes slow things down a bit.
But no direct hit.
But they haven't seen a direct negative impact on their business or their sales cycle or direct costs at this point.
Okay. What about that cost structure and the contribution margin goal? Did analysts push on that?
They did. Management reiterated they expect expenses tied to automation, onboarding, and also marketing and awareness to kind of flatten out over time as they scale up.
So that those costs won't grow as fast as revenue.
That's the plan. Their main variable expenses are really just sales commissions.
Right.
So achieving that 70-80 cent contribution margin target above the $12 million base is directly tied to revenue growth, outpacing the growth of these non-commission variable expenses as they flatten.
Makes sense. And cross-selling. Any more color there?
Yeah, they drilled down a bit, again, pointed to the single platform as key, but also stressed the strength of their customer relationships. Management actually used quotes like, "they like us," and "our technology works."
Okay. Straightforward.
The idea is customers just prefer solving more problems with a trusted provider they already have data loaded up with.
Easier path.
Yeah. Plus, the increasing expertise of their specialist sales teams is helping. And they also mentioned that this deep engagement with customers gives them great ideas for those new high-margin products we just talked about.
Okay. Build versus buy. M&A.
Yeah, that question came up. They made it clear they prefer building new applications themselves on their existing platform.
Because they can do it fast.
Apparently, yeah. They said often in just months. So they're not really interested in acquiring technology itself.
But they might acquire something.
They said they're picky. They'd be more interested in, say, acquiring domain knowledge or maybe customer bases.
Right.
But bottom line, they haven't seen any M&A opportunities exciting enough to actually pursue recently.
Okay. Capital allocation flexibility. Can they change that 50-50 split?
Yes, confirmed. The board can adjust that quarterly. They could even potentially buy back both preferred and common stock in the same quarter if they thought it was the best use of cash for shareholders. They just pointed back to the total capital return so far and their current cash balance as proof they have the capability.
Got it. Last thing, taxes.
Right, taxpayer status. They have about $9 million left in NOL's net operating losses.
So past losses offsetting current profits.
Exactly. But those are getting used up. They expect to become a full taxpayer soon.
Do they know the rate?
Not yet. They said the exact rate is still being determined, but they are looking into things like R&D tax credits and other potential credits to, manage the impact when they do start paying full taxes.
Okay, good overview. All right, let's switch gears now. And remember, everyone listening, this next bit is purely for illustration, maybe a bit of fun, definitely not financial advice in any way, shape, or form. Absolutely not advice, just brainstorming.
Let's imagine we're pitching some, let's call them outrageous but plausible trade ideas based only on the nuggets we pulled from this specific call. Pitching to a very focused investment committee. You go first. Okay, pitch number one. A long position built solely on the conviction that ReposiTrak nails that 80% contribution margin goal.
The 80 cents on the incremental dollar above the 12 EMA base.
Right, but not just that they hit it, but that they hit it faster than anyone expects.
Okay, so the outrageous part is betting everything on Flawless execution on just that one metric ahead of schedule.
Exactly. If they suddenly jump from making 50 cents on the incremental dollar to, say, 75 or 80 cents, way ahead of schedule, and you combine that with their stated double-digit revenue growth, the acceleration in cash flow in bottom line profit could be, well, explosive.
So the market might massively re-rate the stock just on that sudden efficiency surge.
Could happen. Traditional valuation might look instantly cheap. That's the outrageous but plausible based only on that goal they stated.
Okay, that is definitely focused. My turn. Pitch number 2. A long position targeting significant share price appreciation, driven primarily, maybe almost exclusively, by the company's capital allocation strategy.
Okay, the 50% return, the buybacks, dividends.
Yeah. The outrageous part here is believing that the consistent return of 50% of their growing cash flow, plus the buybacks, eating shares, plus eliminating debt and preferred stock, that this whole mechanism creates such a durable floor under the stock and such consistent demand for the stock.
That it drives the price up almost regardless of the wider market.
Pretty much. Regardless of broader market sentiment or maybe even short-term sector wobbles. It's a bet purely on that cash flywheel, generate cash, return cash, drive EPS through buybacks being the dominant force, pushing shares towards some target value based on hitting cash return milestones.
Right, so the value is almost mechanically driven by the cash return policy itself, assuming the cash keeps growing.
That's the outrageous angle, betting purely on the allocation driving the stock.
Interesting. Yeah, both ideas really strip down the complexity, don't they? They just hone in on these specific, potentially powerful levers management discussed, that operational leverage potential and the disciplined cash return strategy.
Okay, so let's wrap up this deep dive. ReposiTrak's Q3. Definitely strong results on the surface, particularly that conversion of revenue growth into faster profit growth.
Yeah, that leverage is key. And their single technology platform really seems to be the engine enabling both their internal efficiency and customer adoption through easier cross-selling.
Right. And interestingly, despite that FDA extension, it sounds like market forces, led by the big retailers, are keeping the adoption momentum going, creating that network effect they talked about.
And management seems laser-focused on generating significant cash, consistently returning half of it to shareholders, building up the balance sheet, and staying debt-free. Lots of discipline there.
Okay. And one last time. This discussion was based entirely on the earnings call transcript.
Yeah.
It is absolutely not financial advice.
Not advice, just unpacking the call.
So we've definitely unpacked quite a bit here. I guess the question for you, the listener, to maybe mull over is, how significant is that potential jump from 50 cents to, say, 70 or 80 cents contribution margin? Could that single metric really define the next phase for this company? Something to ponder. Thanks for joining us for this deep dive into ReposiTrak.